liquidity coverage ratio, LCR. And really, what this is trying to force banks to hold liquid assets so that in a time of crisis, they will be able to continue to get people to lend the money against those assets or to sell those assets and convert them into cash. That sort of sounds great. I think the challenge that people are finding is in the in the definition of what that liquidity ratio should look like. So, for example, I think when it was first proposed, the suggestion was the only thing. So you can see from the slide that what you do is you take high-quality liquid assets and you divide by your cash outflows over a 30-day period, all the money you owe to people. That has to the assets in the numerator have to be at least equal to those in the denominator, which, by the way, means that everybody will have way more than that because no one's going to run 101% and find out they go to 99, and then they're going to be in the Wall Street Journal, and there'll be a banking crisis. And so you set a level, and everybody's got to be way above it because that's the way the world works. The proposal initially was that the numerator would include cash and sovereign indebtedness, but sovereign indebtedness couldn't exceed 40% of the total. Which means that banks just have to take, instead of simple example, instead of making a loan to some company, they just have to sort of go buy U.S. Treasuries and essentially earn a negative return because we don't fund ourselves more cheaply than the U.S. government. So between the market as a whole and the regulators, they're working on this issue. I think the next iteration was to say, well, why don't we add corporate securities that are rated AA- or better and ascribe a haircut to them, so we shave the value that we give you credit for in that numerator down somewhat. It's helpful, but there are many assets that people hold, like gold or oil, or equities that trade very actively globally all the time. That are not yet in this equation in which banks are talking with regulators about and saying, you need to include these things in the liquidity ratio, because if you don't, you're going to force us to buy a lot of stuff that's going to earn negative returns. The returns will drag the returns of the firm down overall, and the only way we can survive is if we generate attractive enough returns to attract capital when you need us to have more capital. So you want us to be profitable. Don't come up with a bunch of rules that make us significantly less profitable. And so we'll have to wait and see how that goes. But I think it's quite a good idea. But it's very important to get it right. And I think one of the things that's happening now, or perception from, of course, the market side of things, is that everyone, understandably, is running as fast as they can to kind of put new rules in place, which is great. We just got to make sure the rules really make sense.